The broadcast is now starting. All attendees are in listen-only mode.
When will this thing start? Charles, I agree with you. Believe me, I'm sweating bullets right now because we've been trying to get this thing up and running through GoToWebinar. A bit of a snafu. Sorry about that, you guys. New time zone. No, we kind of switched times, I guess. I don't know. Bit of a snafu, but everybody can hear me okay right now? All right, good. Let me get this thing started. I know you guys are tired of waiting on the sidelines there. Why won't it let me record now? Not letting me record.
Hey, Eric, I show it's recording on my end, so we're good to go.
Okay, you're okay. All right, so we are recording. One thing I say at the beginning of all these, you guys, is please watch this again relatively soon after. Even if you are familiar with this particular strategy, I'm going to have some specific rules that go in and around this strategy to increase your probabilities of success. And you can't use this strategy all the time with my rules, and that's okay. We'll find something else. We couldn't find one. And that's the idea, is you kind of start out with your market assumption and then build from there. And if it doesn't fit the rules for a particular strategy, it's not worth trading that strategy. There's other opportunities out there. So stick with that as well. All right, thanks, Gary. Sorry about the late start, everybody. Yes, Dominique, you are perfect timing. I was stressing out over here on the sides trying to figure this thing out, and we finally got it figured out. All right, so this strategy is going to be for beginners. Now, but keep in mind, I'm building this whole course out based on, you know, I'm trying to weigh whether or not it's easy to understand versus your risk parameters. And this is one of those things where it's relatively easy to understand, and it's starting to increase our risk parameters here. So it's not like doing a debit spread. This is actually going to be doing it for a credit. But the idea is this is a stepping stone into getting used to doing like naked shorts and things of that nature, which is, it comes with a higher risk tolerance. But when you start getting used to this, that's when you can kind of expand your horizons, start spreading this strategy out, making it a wider spread, and then, excuse me, eventually get to like naked strategies as well, which is a higher probability strategy than a put spread. And I'll show all those nuances throughout this webinar. Anyway, a couple of things to go over real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 25 years now. I started trading in college with some money I had earned trying to get a degree in psychology. During that trading, kind of teaching myself how to buy and sell stocks and what values were and all of that stuff, I decided to switch over to finance. And then after graduating with a finance degree, ran up to Chicago, started working on the floor as a runner, moved into the pits, and been trading, you know, the entire time with my own money. Anyway, I've traded everything from stocks, financial, futures, commodity, currencies, and options on all these products, basically in all market conditions. So I've seen it when it's really crazy. As a matter of fact, I was standing there watching 9/11 happen, and I was legitimately one of the first people to say it was not an accident when we saw the second one hit. But that's a different story. Anyway, any opinions, news, research, and analysis, or other information contained here are material provided by ProTrader Strategies or associated companies or employees, is provided as general commentary, does not constitute investment advice or solicitation to buy or sell any of these securities or strategies we're talking about. Okay, that's a mouthful, right? Basically what this is saying is I'm going to be talking about stocks possibly that I have in my account. I'm not trying to get you guys to lemming off the cliff with me. What I'm trying to do is teach you guys how to swim, in a sense, so that you can swim for yourselves later on. And what I'm talking about may be counterintuitive to what you're already doing. If I'm talking about shorting Tesla and you're long Tesla and stuff like that, you know, the idea is take these rules that I have around these different strategies and implement them when they fit with your own market assumption, in a sense. All right, and please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, you can follow me on Wolfman's blog. Really important right now during earnings season, because I tweet out all my, well, most of them. I forgot to tweet out my IBM one yesterday, but and you can reach us at or follow us at ProTraderStrat for different market wisdom and stuff like that. Get mostly snark and earnings trades for me. All right, so this particular one is, like I mentioned maybe once before, this is going to be on the short put spread. We did the short call spread last week. We're continuing to build out on this. These are going to get more, and they're not necessarily going to get, like I said, more difficult to understand, but you know, is a naked short call or a naked short put really right for somebody that's just getting into options? Probably not. So that's an easy one to understand, but it's going to be more of an advanced strategy. This is the short put spread. It may be a little bit more difficult to understand than just the naked, but at the end of the day, it's got a lower risk parameter. So I'm trying to weigh all of those things, and I think that this is a pretty good order. So short put spreads. One of the few things we got to remember about the short put spread is we have a bullish market assumption, bullish to neutral. As a matter of fact, we can even be slightly wrong on this, more wrong on the naked puts than on a spread, but bullish to neutral. If it stays right here, we're winner. You know, I mean, if you guys watch my daily market commentaries, like I mentioned, I talked about IBM. I was directionally wrong with IBM selling puts, but volatility coming in, you know, that theta decay that happens on the last day, because today the options expired, I was able to get out for a profit despite the fact that, you know, I was $2 away from having my strikes hit. They did hit overnight, but that doesn't really count. But that's my point. That's the beauty in collecting a credit, is you can be directionally wrong and still make money, just like that IBM example for the earnings. This is a credit put spread also. It's also known as a credit put spread, you know, bull spread. There's all kinds of different names for it. You know, a short put spread, bull put spread, credit spread, whatever you want to call it. I'm going to just call it the old bull put spread. All right. Then, like I said, market assumption, we always receive a premium. You should never be able to set this up where you can't, but it's always a credit spread. We're going to try and take advantage of theta decay. We want theta decay in our favor. We also want volatility to contract, so we have to do this in a high implied volatility environment. The reason why volatility has this tendency to, well, it does, it pumps up premiums as people buy options, especially on the put side when they're trying to get protection. That pumps up premium. That ultimately is what increases volatility. And as those premiums get pumped up, theta decay can't really happen. It can't really happen as volatility is going up. It kind of offsets that. And then when the volatility comes out, all of that premium comes out all at once, and that's the beauty in it. So we want volatility to contract. That gets us to our exit quicker than we would normally have to just watch theta decay happening, even though theta decay is going to be ramping up while we're doing this strategy. All right, I always go through this, essentials to success, you guys. Picking the right underlying. What does the picking the right underlying mean? I'm not talking about you're picking the right directional assumption here. What I mean is picking the right underlying. You know, everybody trades all kinds of things, right? I can show you a bunch of examples. We could pull this up right now. We got UPS just because I have it as an example. But the idea is a stock under $100, we need the bid ask to be less than 10 cents wide. This is a $130 stock. So my rule of thumb on anything over 130 or sorry, over $100 is move the decimal 3 ticks to the left, and that's what our bid ask should be. This is 13 cents. So these from the bid to the ask should be no more than 13 cents wide. This fits the rule of picking the right underlying. We can look at something like Ulta, and we can look at Ulta, and we'll see that it has, you know, 60-cent bid ask. It's usually 40 cents during the day, 40 cents to the bid and the ask. We look up here, it should only be about 25 cents wide. So that's a little bit of a stretch. I'd look at Ulta usually for earnings, and that's about it. They do get tight markets during earnings. You know, if we look at a comparable Tesla, let's say, you know, $350 stock, we looked at the bid ask, it should be about 35 cents wide. And generally speaking, these will be 35 cents wide, as you guys probably know from trading Tesla. These markets have gotten a little wider on the Friday, but rule of thumb would be 35 cents for something like Tesla, and it's usually inside of a quarter. Place, not learning anything, but thank you. Charles, what's that? Oh, it seems I'm all over the place. Well, these are rules. I hope I'm not all over the place. You know, we're building this out to decide whether or not this strategy is appropriate for what underlying we're looking at, right? So the first thing we have to look at when we're looking at an underlying is the bid ask here. So if we're looking at a right underlying, this, you know, when it gets too wide, it doesn't make sense to get into this strategy with options because you have to give up so much edge to get in and so much edge to get out, okay? Thank you, Gary, I appreciate that. So bid ask is very important, especially for options. You know, when you're looking at a market up here 30 cents wide, that's not a big deal when you're giving up 30 cents on buying a stock, but when you're doing this with options, you know, and we're talking about commissions and everything else, if I have to give up 35 cents and offer this at 11, right, to get in, and then I wait 2 weeks and the market's gone my way and volatility has gone down and theta is contracted and all of those other things that we want happening for us, now it's offered at 11. Well, I might have to pay all the way up to, you know, $10.95 to get out before anybody comes in because there's just not enough participation in there. So I took all of that risk and was unable to really benefit from it. You know, 5 cents is going to be basically your commissions in the trade. You took all that risk for nothing, really. So that's why it's very important, you guys, for the picking the right underlying. And that's what I mean by that, is making sure the bid ask is pretty tight. So always do that step when you're looking at, hey, I think that Alta is is bullish. I'm bullish in Alta. And you go in and look at there, well, if those options aren't really tight, then I would just I would go a different route, to be quite honest. All right, so picking the right strikes. What we're going to be looking here is we're going to be starting to build this strike out with a negative, or with a 36 delta short put strike, okay? That's where we start. It's not where we necessarily end. The reason why we're doing that 36-ish delta, if you add up all of these probabilities underneath this half standard deviation, all of these are going to add up to very close to, it's 31 or 32, but we're going to be looking at about a 36 delta. That's where I found that I can get the most bang for my buck, in a sense, where it makes my risk worth the profit, in a sense. It's a good risk reward ratio, in a sense. So what we're going to be looking at, and I know there's a lot of people out there that are savvy traders and will say, well, the skew usually looks like this on the bell curve. It does. I'm not going to argue positive and negative skew, but this gives you a ballpark idea. Even if the skew is in there, they're still going to have the same probabilities from this midpoint, 50% probability, 50% probability. So let's not really get into the weeds there. I know there's skew to the bell curve. Somebody mentioned that to me after the class last week. So, but this gives you a pretty good idea. How can you defend against the widespread? Jerry, we'll talk about that in a little bit. It's more of like, it's going to be a kind of like a mental stop, in a sense, to get out when you do the real wide one. All you're doing there is really limiting your margin. My rule for it usually is to buy the first option I can for a nickel to define the risk. That's not what my risk I'm willing to take is, but it does limit your margin. And, you know, if you're doing it on a IRA or something like that for the calls, it makes it appropriate. So that's what we're looking at there. Does that make sense? Okay. Caesar, I'll get to you in just a second. Can you create a scan with these parameters, bid ask, spread, volume, etc.? I haven't done that, Brian. What I usually do is I start looking through the stocks, and I'll go through that when we pull up the webinar or pull up the trading platform. And we're going to go through these steps just like we would as if we were going to trade this spread. And I'll show you how I go through what my scan is. And it's basically a simple applied volatility scan, to be quite honest. All right, so picking the right duration. And I'm sorry, I'm kind of pushing through this a little bit faster than normal, but because I know you guys, I got you guys started a little bit late. But picking the right duration here, you guys. We want that theta decay to happen, right? We talked about that. We want theta decay. We want volatility to contract. This is a theta decay curve, and yes, I understand the further out on the curve you go, or the further away from where the underlying's trading, this curve really isn't good for like a 10 delta option. This is really at the money option, just to give you guys a visual as to what's happening to the premiums. And the idea is that the premiums are going to decay. We used to call it theta, the thief that would come in the night to steal your premiums. Well, we want that thief when we're selling premiums. We want this to decay. And the reason why we want it to decay is because that we shorted premium, right? And if we can buy it for less than we sold it for, then we're winning. Now, another thing is when volatility starts increasing, what happens to this curve is it kind of does this, it pushes it out. And what we want is it kind of flatlines. It doesn't allow theta to happen. It increases in premium, offsets the decrease in theta. Well, what happens when that volatility crashes or comes out? Well, the premiums crash as well, and then it catches up, all right? So the idea is we're trying to catch it when volatility is high, so that when we get it, volatility to contract, it catches back up, and that's all we're really trying to do. Also, when volatility is real high, those premiums are pumped up. It allows us to get further away from where the underlying is currently trading, okay? And that has to go to all goes to where we are in picking the right environment. High implied volatility, good theta decay, ramping up. So basically we want to get inside of 45 to 35 days, that, you know, inside of that, you know, we're right around 20 some odd days right now. We're still able to capture a lot of theta decay. I really love putting these on right around 45 to 35 days. It seems like you can get a little bit further away, still get that nice premium. You know, the closer we get to expiration, that premium gets a little bit tighter, and we got to get closer to the market, but it is what it is. Picking the right environment, if we can get it with high implied volatility, we know we're getting the most premium we can, because when it's the highest implied volatility, 100% implied volatility, that's the most premiums we've seen in the last 52 weeks in a sense. So we want high implied volatility to pump up those premiums. And that is what we're talking about with this one. So with the bullish put spread or the short put spread, we are looking for an implied volatility percent of above 50. It's an IV percent of above 50 for any stock. ETFs, we're looking for above 30. The reason why we go a little bit less for ETFs is because there's a basket of goods there, and that basket of goods has a tendency to have all their different volatilities average each other out, right? That makes sense. You got 30 some odd stocks in an ETF, and all of their volatilities will have a tendency to average each other out. IB is numero uno. That is correct, Brian. That is the very first thing I look for. All right, so knowing your exit strategy before entering the trade. Well, when we're looking at this strategy and building this out, we're looking to collect about a third the width of the spread. Okay, so on a dollar wide spread, we're looking to collect 33 cents. Okay, on a $5 wide, we're looking to collect about $1.50. It's a third the width of the spread. And when we're exiting the strategy, we're looking to take about 50 to 70% our max profit. So like I mentioned, in the one with 33 cents, we're looking to get out at around 15 or 10 cents. Okay, somewhere right around in there. When you're dealing with the $1 wides, it's kind of you kind of got to lean towards that 70 percent because of the commissions. The commissions are going to really eat into your profit, or you need to do it at least like 2 or 3 contracts, right, to make up for it. One contract makes it very difficult on this strategy to make very much money, especially with the commissions. And depending on everybody's commission structure. One thing I always say also is, if you haven't checked with your broker lately on your commissions, go and ask them. It can't hurt. I wouldn't do it every week or every month, every 3 months. I would do it maybe once a year. Call them up, tell them how much you paid, tell them how long you've been with them, tell them, hey, you know, I'd appreciate a cut of my commissions, and they most likely will, so they don't lose your business. Do you hold through earnings to get vol crush? I don't usually put this strategy on well ahead of earnings, but absolutely I will use a, you know, short put spread for earnings. You will never see me do a debit on earnings. Volatility is too high. I could be directionally wrong. I could be directionally correct and still lose money, when you're doing debit spreads around earnings, just like you can be with a credit spread or a credit strategy, be directionally wrong and still make money. That's the beauty. You're taking a little bit more risk, but you have more ways to be right and a higher probability of success thus. All right, does that make sense for you, Jerry? All right, so 50% of our max profit is kind of like what we're looking at. So when I was talking about max profit, basically it's the width of the spread. Max profit is is basically the short put minus the long put debit. So whatever that we pay or whatever we collect as the premium is what our max profit is. But basically it's the credit minus the debit we paid for that long put, and that is what your overall profit is for that max profit. You know, so for $1 wide, we collect 33 cents. We're probably looking to get out about 15 or 10 cents. $5 wide, we're looking at about $1.60, so we're looking to get out at about 80 cents. Max loss. Our max loss is the difference between the two strikes minus the credit we receive. So I talked about that. Our max loss in my examples would be on $1 wide, we collected 33 cents. Credit received 33 cents. The difference in the strike prices is $1. Basically, our max loss is 66 cents. On the example of a $5 wide, difference in the strike prices, $5 wide minus the $1.60 we received, then our profit would be, max profit would be $1.60, and our max loss would be $3.40. That's at expiration. We're not looking to go that far, you guys. We're looking to get out of this relatively soon to increase our probabilities of success. All right, break even is the short put strike minus that credit we receive. So if we are short the 100 puts and we collected $1.60, then our break even is when it is trading $98.40. That would be our break even at expiration. It doesn't necessarily mean during the duration of that strategy, but it means at expiration. All other things will change during that time. All right, how do we defend this when the short gets tested? Well, if we are doing it set up like I set it up, okay, where we are risking, we're doing it for a third the width of the strike. On that type of strategy, I don't usually defend it. I'm looking for the probabilities, okay? And the probabilities of success with this strategy is going to be about 65, 66% probability of success. So it's better than 50-50. I'm not saying it's the best probabilities out there, don't get me wrong, but it is better than 50-50, which is your probabilities of correctly buying or selling a stock, right? Your probabilities are better doing this strategy than anything you can find in Vegas. You know, so your probabilities are much better than just trading when you're going out and deciding on a future to buy or sell. You know, your probabilities of success there are quote unquote 50-50. So we do have a better percent probability of success. So with this, I usually don't do it when I'm defined risk. If you're starting to do it where you start spreading out the width of them, I usually say we're going to be looking at taking, if I collected 33 cents, I would be looking to get out at around $1 or 3 times what I paid. So that's how I do it. Your risk parameters might be very different. I look at it like I'm playing the probabilities, and the probabilities, if I can get out early, are going to increase those probabilities. So like if I can get out early, my probabilities really go from about 65 to about 75 to 80% probability of success. Much greater increase. So that's the key of getting in and out. And I don't have solid statistics on that other than back of the napkin math that I've done over the years just with my trades, and you know that's skewed. So you know, because one could say, well, I pick the market better than other people, which I don't believe I do, but you know that could be said for my success on it. But I feel strongly that that is a pretty solid number. Friday interpretations, please send recording, thanks. Okay, interruptions, Chuck will do. It'll get off to you probably late tonight or early tomorrow. All right, so let me get into the platform and try and answer some of those questions that people were asking a minute ago. So this is what we kind of look at when we're pulling it up. This is where I throw in on my watch list. I don't know if you guys have a watch list or not, but over here in the gears, I added in implied volatility percent. And what that is, implied volatility percent, is basically every stock out there has implied volatility, right? But all implied volatilities are not equal. Something like Tesla, pretty high volatility stock, right? It moves all over the place. It's got a 43 implied volatility. So to find the percent where it is now in relation to where it's been in the past, because all of them are different, but they will have a tendency to kind of reach, hills and valleys in a sense, near the same places. So the idea is that it's going to revert back to the mean. When it's really low, it's going to want to go back to the mean, right around the middle. When it gets too extended to the upside, it wants to revert back to the mean, back to the middle, all right? So where do you go when you're right there at 50%? Well, I still say go ahead and look to sell it above 50%. But you can wait it out a little bit longer, but it meets the rules in a sense. Okay, and what it is there's a numerator and a denominator. In the numerator, we take the sum and divide it by the sum in the denominator. In the numerator, we find the sum from where it is currently to where it is the low, and that's from, let's say, 43 to 28, just to round it off. 43 to 28 is 15. You take that sum and divide it by the high, which is 53 minus 23, or 53, sorry, 53 minus, what is it, 28? 53 minus 28 is 25. So 15 divided by 25, it gets you slightly closer to 50%. I think it's 50%, 60%, I should say. Couldn't do that math right off the top of my head real quick. But anyway, so you get the idea. In this numerator, current minus the low, divide that sum by the high minus the low sum, okay? And that's where you come up with that IV percent, which is all over my platform. That's the first thing I look for, okay? Okay, it's above 50. All right, I'm looking at it. I have a bullish assumption in Tesla. All right, I would look to sell some premium. How do I want to sell premium if I'm bullish in Tesla? Well, I could do a lot of different things, but we've decided let's check out the short put spread, all right? And assuming the next thing we do is look at it, it's got tight bid ask. Of course, the bid ask on this is blowing me out right now. So let's try and find something like Apple, or let's see, TBT has 100%. That's a high implied volatility percent for sure, as TBT is probably going through the roof right now. So assumption here, let's just say, that's the first thing I look at, high volatility. Well, hey, TBT has high implied volatility, plus there's no earnings, so I don't have to worry about that. I am thinking the Fed is going to continue to increase interest rates, which TBT is the ultra short in the bonds, which makes this inversely related to what the bonds are doing, is the bottom line. But it's if the bonds go down, this should go up quite rapidly. So let's look at this. I haven't vetted this one, but let's just take a look. First thing we look for is that 36 delta. All I got is a 31 delta. It's trading right around $1 away. So let's just see if it works out. So my rule is 33%. It's kind of 33% the width of the strike to 25%. The very low end being 25%. So $1 wide, 23% doesn't fit the rule. What I might want to do if I was really bullish on this is just kind of crank it up a little bit and try and get a better credit and get hit on it. This would not fit the rule on the width of the spread. Everything else fits. Tight bid ask. Everything's got wide bid ask right now. TBT usually has pretty tight markets too, but it should be 10 cents wide. It's pretty close. 6 cents wide, so it's pretty close to 10 cents wide. On a weekday during the day, it would be there. Probably be 2 or 3 pennies wide. And that could be throwing off some of my math for this. If I could sell this at 50 something and buy it back for 20, it's probably closer to where I'm pricing this anyway. So that would be 25 to 35% the width of the strikes. That's what we're looking for. All right, so on this, our max profit would be like 28 cents. I'd probably try and get out at around 10 or a little bit less than that, just because I'm getting such a little credit, and my commissions are going to ramp that up a little bit. But dollar wide, 28 cents. My reward is 28. My risk is 72, right? It's the width of the spreads minus the credit received. So that's our max loss. So that's what I'm looking at for this. It's really hard to be mechanical with this one, other than to stay sure to your assumption and your probabilities of success. Another thing to look at for probability of success, what we can do, and I didn't write this down, so let me just try and find a clean slate here and we'll look at it. One way to look at this probability of success is this strike only has a delta of 31, all right? So our probabilities of success, delta tells us
this customized horizontal line table
it's 31%. So that means that TBT is trading $34.99 at expiration. That would put this strike in the penny by one, or in this strike in the money by 1 penny, right? That's only a 31% probability of that happening. Means 61% probability of it, or 69% probability of being in and out of the money. That's the easiest way to figure it out. When you're doing it on a call or a put spread, what you can kind of do here is cheat a little bit, and you can go like this. What you do is you take the risk, your risk, what you're totally risking minus the width is the easiest way to think about it, the width of the spread. So our risk, so our risk is that 72 cents, right? 72 cents on that strategy divided by a dollar wide. Okay, and that gives us a 72% probability of success. All right, so a little bit better than what my back of the math is. It's a little bit less. It's showing a little bit less of a probability. This is more closely related to the probability of success with that. So when I said, 68%, our probabilities of success are slightly better, but this is floor trader hack. That's what we look at. You don't have to do all the spreads. The reason why when you're doing that spread that tight is that premium will increase a little bit, help you out if you're directionally wrong. That allows you a little bit more breathing room than just doing it as a naked in a sense. Okay, or just looking at the one delta there. All right, so it's 72% probability of success, and if we get out earlier, those probabilities increase even more. I see a bunch of questions coming out, so I'll try and answer a couple real quick. I can catch up to see where I left off real quick. Sweet spot between probability and return on investment. Brian, I think this is one of the best ways to set it up to get that equal. I've seen people do it where they do like, 20% the width of the strikes, where they're collecting $1 to get $5 in. I think that your probability versus ROI is much less there because your return on investment starts dropping precipitously. What platform is this, Gary? Gary, this is the Thinkorswim platform. Does it matter if it is trending stock like CAT, BA, or downside GE, Procter & Gamble have IV above 50? Dominic, good question. I have a tendency to like stocks and things like that when they've made like a 10% correction, which is one of the things I look at for something like this. How you come up with your directional assumption, if you like to, the trend is my friend, I have no problems with that. If you like it when you try and, I'm a contrarian, so when the market goes up, I want it to go down. When the market goes down, I want it to go up. So, I live a hard knock life, believe it or not. So, but the trend is your friend, so you can play it that way, like Cat and Boeing. But I also like to look at it when I've gotten a big correction, and that's when I'm like a 10% correction is when I'm kind of looking at it. But I like playing with knives, I guess. Is it okay simply to eyeball the IV on the chart to see if it's currently above or below the midpoint? Chris, good question. Yes, I do that. I kind of ballpark it a lot of times. But, you know, just make sure it's above 50%. It would be, you know, at least very close. And, you know, this 50%, like I was even looking at a couple of them and betting them, and they were, you know, the IV percent was 49 something, right? I'll still look at that as long as my assumption volatility is going to decrease, right? All right, so in a previous webinar, you mentioned about one of your option courses that is all-inclusive course on options. Can you name that? Caesar, we'll have somebody reach out to you about that. I don't know the exact name of it right now. What about selling a 50% delta and buying the 30% delta? You'll get more credit for it, Andreas. But remember, when, you know, if we look at this same thing here, if we collected 50 cents and our risk is 50 cents, right? Just for example, you can see easily that if I collected 50 cents or did a 50 delta, my idea is that we are going to be about a 50-50 probability of success, right? Because if I'm picking that 50 delta, buying the 30 delta, well, if I'm doing that, let's just see if we can find a 50 delta. So if I sold that one and buy the 30 delta, you know, let's see, sorry, selling the 50 delta, buying the 30 delta, we're getting a nice big credit there, 45-cent credit. You're getting a better credit, but now our risk is 55 cents. So I can look at this, and 55 cents divided by 100, or by $1, the width of the spreads, right? And that gives us a 55% probability of success. Still better than anything you're going to get in Vegas, but, you know, is that extra dime worth the extra 20% in risk? I'd lean towards, I'd give up the nickel for the extra 20% probability of success. Does that make sense? That's what, I mean, you guys, that's why I've kind of gone through all of these things over the years and years, is, you know, weighing all of these options. And this is what I found out to be the sweet spot. You know, yeah, you could be like, all right, well, you know, if I did it on the $5 wide one, right, my risk is $4. $4, I should make a dot there, $4 divided by the $5. You know, my probability of success is much greater here, which would be basically equivalent to basically collecting, what is that, 20 cents? That'd be like 20 cents on a dollar wide spread, you know, so we're looking at 80% probability of success. But you also have to, you know, this is going to be a high dollar, you know, we're looking at doing Amazon or something like that. So that's, you know, going to be expensive to lose that. So that's why I've gone with this one here. All right, so let's look at a couple of, usually I throw it out to you guys to throw it out, a couple of examples. So you can do that. We'll try and get a few of them in if I can. TBT though, this one didn't come up on my radar today. I might be looking at this one pretty hard on Monday, so I'll be talking about that in the daily market commentary. One of the other ones that I was looking at was, they were both mostly ETFs, to be quite honest, you guys. They have high implied volatility right now. And the reason why they have high implied volatility, we've got so many earnings going on that it makes it hard to find anything that doesn't have earnings that does have implied volatility of above 50. So I was looking at a lot of ETFs today. This is another one. We look for like the 36 delta closest to. I'd much rather get further away, which means a smaller delta if I can. So we do something like that. That doesn't fit the rule. It did when I vetted it earlier today. It was working out. XLK was another one that I was looking at, which is the ETF for the technology sector. If you think the NASDAQ is going to continue to go higher, this would be something that we would look at. First thing we look at, is it the right, I have a bullish assumption in XLK, basically based on the charts, let's say. This would be the example that somebody was asking about Boeing, Dominique. This is in a trending channel, right? We're moving higher. I would probably wait for it to come down to the bottom of the trend to really love this, but it is something that has high implied volatility percent, as you can see, just ballparking it. We can look at it down here and see it's a 77 IV percent. So Our rule for a ETF is above 30. This is well into that. Next rule we look at is the bid ask inside of 10 cents for a stock under $100 or an ETF. Yes, that fits that rule. So start looking for the 36 delta. Probably not going to get it with this 26 delta strike here. 16 cents, so we're probably going to have to go a little bit higher. That would be the one that we'd have to pick if we were going to do it. 25 cents just sneaks in that rule. Of course, one thing I always say, you know, this is giving me the mid-market. I always started a little bit higher because there's different, you know, these are different exchanges, the H and the M's and the Z's and all that stuff. Those are different exchanges, so they can't really lean on each other. If I got hit on one, though, it would auto leg it. So always go a little bit higher than where it's suggested, and then cancel replace. It doesn't cost you guys anything to cancel replace a trade. It's going to cost you if you get filled immediately. You put that order in, you hear it go cha-ching, you probably left a few pennies on the table. Do those few pennies mean a whole lot? Well, to me they do, because I know over time those pennies are going to add up to a lot of pennies and dollars. And the other thing is, if you make an extra couple of pennies on it, really kind of covers your commissions, right? So always work that. It doesn't cost you anything to cancel replace, but it could cost you if you get filled immediately. It means that that spread machine just went in there and just started banging stuff around and didn't let it meld, didn't let the market come to you. So I'm not saying like put it in there for 15 minutes. I'd probably put this in, you know, confirm, send, wait for it to get hit, go in, cancel, replace, confirm, send. You know, in about that much time, these algos should have enough time to auto leg you better if they can. If you just bang it out, they don't get the opportunity. All right. Do you check the difference between the bid and the ask in the put side or the call side? Thanks. For that rule, it goes either way. But what I do is picking the right underlying, go to the nearest full month expiration. You know, you could look at January, but this is the real month everybody's looking at. These January probably would have pretty tight ones, but you know, somewhere right around that 45, 35 days to expiration should fit that rule for that tight bid ask. Okay. You know, something like Aeon is going to have really wide bid ask. So, you know, everybody's heard of Aeon, but there's just not a lot of trading in the option. So just stay away from it. There's other opportunities out there better than just that one. Always look for more opportunities if it doesn't work out. So this one, pretty close to fitting that bill. So that's how I would work it. It's you know, about a 70% probability of success. We look at this, it says about a 62% probability of success. Well, when you're doing it as a spread, it's a little bit better on that. Does that make sense? So for a bull put spread, you will check the bid ask spread only on the put side. I'll just check it. I actually have a tendency to only check the call side, to be quite honest. I just look here, quick glance, make sure a couple of them, and then you know I'll just glance over here too as well. But it doesn't really matter if it's tight on the bid ask. If it's inside of 10 cents on the puts, it's going to be tighter on the. It's going to be inside of 10 cents more times than not. That makes sense. Can we trade weeklies if it's 45 to 50 days? You can trade weeklies for sure. If they have weeklies, just make sure those bid asks are still tight. Now, a lot of times with XLK, things like that, if they give you the weeklies, those weeklies are going to have participation. So yeah, you could go out to this 35-day weekly. Just make sure the bid asks are tight. I usually go to the monthlies. I default to the monthlies unless I'm doing like earnings. But I default to the monthlies just because that really is where the most open interest is and the most volume most people are looking at. You know, the reason why is if I put in, you know, if it's 6 cents wide here and I put in a 52-cent bid, it might spread against something. Somebody might be offering something leaning on that bid, you know. I mean, that happens, believe it or not, and it will auto leg you in. So sometimes you can get much better than mid price. And if you're doing outright strategies, it's going to default you. If you're buying it, it's going to default you to the offer. If you're selling, it's going to default you to the bid. So always move that cursor, or always move this to your benefit. Cancel replace. You should always have tons of cancel replaces. Do Do you prefer monthly expiration rather than weekly? Yes, I do personally. Yeah, because the date would be 35 days, makes that in the sweet spot. You know, if I really wanted to do this and I couldn't get it very well with that, I would, especially with XLK, I know that they have a lot of volume and open interest going on at any given time. So this is one of those ones I probably would lean, or at least consider. But just me, out of being me, you can see that there's a lot more volume and open interest than in the weeklies. They're still pretty tight, but you know, there's much less volume and open interest, which means there's much less eyes on this, right? If you give up a couple of pennies here, you're probably less likely to get filled if you give up a couple of pennies where everybody's watching. Would you trade the XPX or the RUT indexes? Absolutely, Steve. Like if you have a $100,000 account or more, then absolutely I look at the SPX. So I don't have to pay all the commissions to get up, or all the commission costs to get up to 10 contracts with the SPY. So yeah, for sure. You can do the same thing with indexes, futures. It should all line up the same. So a third the width of the strike is what we're looking for. Another one I was looking at was Tesla. Home Depot is another one that doesn't have earnings, that has high implied volatility percent right now. We can close this out. 39. It had high implied volatility percent earlier on today. I don't know what happened. It looks like it just got crushed. It went from 50 to 39. So I missed the boat on that one. Gets too much lower. I'd expect this to want to come up, so I may have missed that one. All right, Bobby, good to see you back. Sorry I started it late. So that's basically it. It's pretty simple, you guys. Just remember, a lot of this stuff goes back to making sure that your risk rewards are in line with each other, and collecting a third the width of the strike makes that risk reward much better. Especially a couple of these are going to go against you, and if you get out early, you increase your probabilities. Thus, you switch that whole curve out, whereas the one that goes against you doesn't necessarily hurt you from the ones that you are always winners on. Right? What time frame do you base your trades on? I base them on, I try to get in around 35 days to expiration, like I was mentioning there. But with this one, if we pick this right, you know, we can, you know, really, we could be out much earlier than even 5 days. If you guys watch my daily market commentaries, you'll see I get into a trade, see volatility come out, get a directional move. Like say for instance, Home Depot I did yesterday. I don't like to cherry pick and say, well, if you would have done Home Depot yesterday, you would have been a winner and you would have been out today. I'm not that guy. I'm the guy that tells you, hey, I'm going to put it on, or I just put this on, and I write it out. And I tell you whether it was a winner or a loser. And I talk about my losers more than my winners if you watch the daily market commentaries, because those are the ones we're always thinking of, right? But usually it'll take a bit, you know, you get high implied volatility, no earnings, you can get in and be out within 2 weeks. So 35 days, you'd be out like, you know, 14 to 22 to 3 weeks, I suppose. Volatility really came out of it right away, then you could get out in just a few days, which we've seen happen on many trades that I've done. Do you use the daily, hourly ETX charts? I don't, Caesar. Not that. I just have, I try to look at less things and come up with my own assumptions in a sense. I found that at one point I had so many things going on in my charts, it was like I could never make a decision. So I've kind of narrowed those things down and use a few things that I stick with. I think I got everybody's questions so far. If I missed one of your questions, because it was blowing up when I was trying to talk through this real quick, you can throw them back down in there. I may have missed them at this point. Can a trade go against you in any way? Can a trade go against you in any way? Yes, a trade can go against you well, I guess I don't understand. Maybe the trade cannot go against me if it goes up. I'm going to win. You know, if volatility starts increasing, if the market's going up and away from me and my puts are going further away, volatility starts increasing, that could hurt my strategy. because as volatility goes up, those premiums go up. So I might see a rally happening with volatility going up. And a lot of people say volatility doesn't go up when the markets are rallying. Well, we've seen that this week, that volatility does. You can even look at Boeing. Boeing's volatility went through the roof on its rally. But what I'm saying here is if volatility goes up, these premiums are going to go up, so it's going to not allow it to happen. So yes, if it goes up and volatility goes up, we aren't probably going to lose money on this strategy, but we're not going to be making money like we would want to. If the market goes down and volatility contracts rapidly, then we can make money still, because the volatility and theta contraction will outpace the negative move in the market. Like today, you know, IBM was trading 169 yesterday or something, I think, just off the top of my head, or 139. I think it was 139 actually. I can just take a look. And I sold the 132 calls, or sorry, 132 puts in IBM. So IBM was trading way up here at 170. So I sold the 150. Where did I sell the 162 calls? Sorry, 162 puts, Eric. So the market was trading up here. I sold the 162 puts with implied volatility way up here. Volatility crushed, but look, the market came down. I mean, it actually traded into the 162 handle, 161. That was overnight, actually. But the market came down. I was able to get out in the first 15 minutes of the open for 50-some cent winner. I sold them at 60, bought them back at 7 cents. So I got the directional move wrong, but this volatility crush allowed me to be right. So I was directionally wrong, but still right. And that's the key of what we're talking about with the volatility crush. And, you know, that's the beauty in trading earnings, is that you know that volatility crush is going to happen. So you can be wrong and still be right. And I go over different rules in and around option strategies specifically for earnings, like when you get in, when you get out, how much you should collect, all that stuff, strike location. It's a little bit different, but you know, I go through all of that for earnings specific trades. So check that out on the website too. How about for naked shorting? I'm going to be talking about that, Ryan. I don't want to get anybody confused or anything, but we're going to be doing that here in a couple of weeks on the naked shorting and how to do that and what the best way to play that is. Does that make sense? I don't want to confuse everybody with different strikes and everything else that we're going to be talking about when you get in and out. So basically, like I mentioned, by the way, we are doing the deal on the earnings trades, how to trade options around earnings and what specifically to do, when to look for them, what you need to set these up. So this right here is for that course. You know, this is a great one. You know, I talk about probabilities, playing the probabilities. That's what it's all about. Just if you ever watch like the guys doing Texas Hold'em and stuff like that, they're constantly looking at their hand and thinking about the probabilities of their success based on what they have and what they see. That's exactly how I teach. What the probabilities are, you know, when to get in, when to get out, and how to manage that risk when it starts going against us. So I talk about all of that stuff. You know, just having a market assumption doesn't necessarily mean that, or correct market assumption doesn't necessarily mean that you're going to be right or you're going to win in this game. I go through all the rules to make sure you're setting it up in and around the correct environment for that particular idea that you have, for that underlying, right? And all of those things going together will increase your probabilities of success. I'm confident in that. You know, the only thing we can really do in this is learn, and you guys have obviously done that by taking this webinar, but wouldn't you agree that if you can increase your probabilities of success, or you're constantly thinking about this as probabilities, that you're going to be more profitable? For one, I can assure you that you're going to be able to sleep at night. You know, if you're not able to sleep at night when you have trades on, this is one thing that will help you sleep at night. This whole thing with UPS, I was talking about UPS win against me. I was playing that for the probabilities. I looked at it, I was like, you know, I'm looking at the charts too, looking to see if they were losing a little bit of steam, and UPS looked like it was. Gilead went against me also, but it didn't have the same chart set up, so I stayed with the UPS and was able to see it come back my way. Gilead, you know, broke through where I thought the resistance was, so I pulled the ripcord on it. So I talk about all of those things in the daily market commentaries. As a matter of fact, I think I talked about Gilead and UPS every day this week because of those ones that were going against me. And that's the ones that we really need to keep an eye on and how to trade around those. You know, a lot of times I probably would have taken UPS and, you know, been long UPS, started selling some calls against it and lowered my basis that way. But I didn't want to have that margin hog going into earnings. I want to save my margin for earnings. So I decided to pull the ripcord on both of those and go for high probability strategies in the earnings rather than trying to, you know, work those two into winners is why I didn't. Normally I would, but earnings being the kickoff right now, I decided to get away from it. So for 36 bucks, you guys should take advantage of this. I forgot to put it in the link window. Let me just put it over there real quick. This is going out to everybody. So we've been communicating in the questions box. Check out the chat window. I got a link there. If you're watching this on tape delay, you can just pause it, write down options course, type that into your URL. Just a quick thank you, guys. I want to thank you guys all for attending this webinar. Sorry for starting it a little bit late. We had some snafus, but in later webinars, we'll be drilling down on different option components, how to trade options, trades I find, when and where I find them appropriate. Here's also the link. It's not a hot button. You'll have to pause it. And if you have any questions, contact us at 310-598-6677 or email us at trading@protraderstrategies.com. Also, if you guys want me to do a webinar on something that you haven't seen, write to us, tell us. Be happy to do it if I've missed something that you guys are really looking at. So take advantage of that as well. We're always looking for new ideas and stuff like that. And if I've missed something, you know, there are strategies out there I haven't covered, believe me. And some of the reasons why is because I don't believe in them. They're too low probability, things of that nature. So I just don't really do them. You know, like on a credit calendar, I'm not going to do a credit calendar spread for various reasons. So anyway, take advantage of this, you guys. It's a really good one. This is all about earnings. I'm going to be talking about earnings in the daily webinars. So you guys probably should take advantage of this. Get on that daily webinars or the daily market commentaries and follow along with me. Follow me on Twitter. I'll be tweeting out what I'm doing. I'm just basically saying I'm going to, you know, selling some puts in IBM. I'm not going to say the strike because those of you are those, you know, you guys paid for this information and learned it. You will know exactly where I am picking a strike because I'm going to be following those rules. Is this course both pre and post earnings? This is mostly pre-earnings. I'm not sure if I have the post-earnings one in there. I probably should add post-earnings ones in there because I do have a few of those, Caesar. So it might be a good idea to add in there. But right now, I'm not sure, but there's probably 10 hours of video content here on, you know, short calls, short puts, put spreads, strangles, iron condors, all that stuff. So have all the spread strategies in there that you can use in and around earnings and when and where to do them to increase your probability of success. So go ahead and click on that link there, you guys, and watch those daily market commentaries. You know, those are really important too. All right, that's all I got for you guys today. If you can't take that, take it easy. JQ beat me again. Thank you very much, Andrew. I appreciate the kind words. Thank you, Caesar. Mike, appreciate it. You guys all take care. Have a great weekend. And again, I'm sorry about the snafu earlier today.